Today, we're opening up a market that, well, at first glance, it really promises the moon. Belarus.
Mm-hmm.
Since online gambling was legalized back in 2019, you often hear it framed as, one of Eastern Europe's big emerging opportunities.
Right, the next big thing.
Exactly. But if you actually dig into the data, and we have, you pretty quickly realize this supposed opportunity is guarded. Guarded by massive, kind of unseen barriers.
Absolutely. Hidden walls.
Yeah. So today we're doing a deep dive into a really excellent country-specific report. This comes from the Gambling Databases research team.
Good stuff from them.
Yeah, they're a group really dedicated to delivering these super in-depth analyses of the global iGaming landscape. They explore, everything from local regulations, taxation, operator conditions, urging trends, the works.
Really get into the weeds.
They do. And our mission today is pretty straightforward. We want to pull out the key insights from their findings, really focus on those regulatory traps, the hidden financial burdens, basically give you a clear, data-driven understanding of what makes this market genuinely unique.
And maybe dangerously expensive.
That's putting it mildly.
Yeah, what's fascinating here is that contradiction you mentioned right at the start. You look at the paper, the legal status is simple. Online gambling fully permitted, regulated by the Ministry of Taxes and Duties since, April 2019?
Seems straightforward.
But the report hits you immediately with this critical warning. These really strict, localized requirements, coupled with, frankly, severe political and economic challenges, mean any international operator has to approach this with extreme caution. It's a very, very high-friction environment.
Okay, let's jump right into that friction then. Let's start with what the report actually calls the capital wall. Oh. What's the absolute biggest, most immediate financial hurdle for someone wanting an online casino license there?
Okay, it's the mandatory reserve deposit. And you need to sit down for this. We're talking 985,500 euros, 985,500 euros.
985,000.
500 times.
Wow. Just under €1 million.
Yep. And this is the absolutely crucial point, and it feels like a deliberate mechanism to filter out everyone but the biggest players. Mm-hmm. This capital is non-operational.
Non-operational, meaning?
Meaning you have to lock it away. It sits in a designated Belarusian bank account for the entire duration of your license. It's not working capital you can use for marketing or salaries or anything.
So it's just dead money. Guarantee sitting there.
It's a passive sunk guarantee, exactly. Almost €1 million just sitting there completely idle.
Why? Why is the government insisting on a reserve that large? Is that just standard security practice, or is it, like you hinted, a deliberate barrier, maybe designed to keep out smaller, perhaps more agile Western firms?
Well, it probably functions as both. I mean, it definitely provides a massive financial safety net for the state should anything go wrong. But yes, it is absolutely a deliberate barrier. And the report makes this really clear when you contrast it with the sports betting license, because sports betting is seen as, lower risk, maybe more culturally ingrained already.
Right.
That mandatory reserve drops significantly, down to $219,000 there.
Okay. Still a chunk of change, but way less.
Way less. That difference, nearly $770,000, shows you exactly where the state wants to control market access. And it makes the actual application fee, which is just $2,737.50, look like a rounding error. It's completely insignificant compared to that locked reserve.
Okay, so that's a huge upfront barrier.
Right.
But beyond that massive locked deposit, the report says international operators face these really stringent operational demands too, things that force them to root themselves really deeply into the local infrastructure. Mm-hmm. What are the key technical and sort of physical mandates?
Yeah, the requirements are, let's say, intrusive, very intrusive. First off, the physical infrastructure. Yeah. All your servers, the ones hosting the actual gambling platform, they have to be located within the territorial borders of Belarus.
So no centralizing your tech stack somewhere else in Europe? Nope. Can't do it. Got to be on Belarusian soil. Second, you absolutely must use the mandatory local domain extensions. So that's either the Latin script.b or the Cyrillic mangi. Okay, localization required right down to the URL.
Precisely. And adding to that, operators have to maintain 2 separate bank accounts with Belarusian banks. One's your general checking account for operations, and the other is, of course, that locked reserve account we talked about.
Right, more local banking integration needed.
And finally, there's a human capital aspect. Key personnel, think management level, they have to demonstrate a minimum of 3 years of relevant industry experience.
Which could be another friction point for purely international teams trying to just, parachute in management.
Exactly. It adds another layer of complexity, another hurdle.
Okay, now let's pivot slightly to taxation. Because like you said, on paper, This looks like the market's biggest piece of bait, doesn't it?
It really does.
The headline tax rate on gross gaming revenue GGR, which, just to remind everyone, is the positive difference between the bets operators take in and the payouts they make. It's set at a globally competitive 4%.
Yeah, and that 4% GGR figure is, well, it's a major distraction. You absolutely have to calculate the total combined tax burden to see the real picture.
Okay, so what's hiding below that 4%?
Well, below that headline GGR tax, you've got the standard corporate income tax, which is 18%. That's pretty normal.
Right.
But here's the kicker. Here's the critical line item that makes expanding here potentially financially punishing. The employer Social Security contributions. They are a staggering 34% on gross salaries.
Wait, 34%. On top of salary.
34%. It's immense.
That's catastrophic, like you said earlier.
It really is. That single expense line basically puts your labor costs far, far above many Western European norms, and it essentially erases any perceived tax advantage from that low GGR rate almost instantly.
So when you add it all up,
yeah, when you combine the locked, nearly €1 million capital, the mandatory local infrastructure setup, and that enormous 34% social contribution on salaries, suddenly the market looks far, far less fiscally appealing than that initial 4% might suggest.
okay, so the costs are high, the barriers are significant. Who is the target audience then? Who are operators sinking these potential millions into reaching? Let's analyze the player profile. What does the size and the demographic makeup of the market tell us?
Well, the constraints here are pretty fundamental. First off, we're looking at a small population overall, only about 9.18 million people.
Not tiny, but definitely not huge for a national market.
And crucially, it's actually declining year over year by about 0.5%. Plus, they have an aging demographic. The median age is 41.3 years.
Older population, shrinking members.
And critically, the GDP per capita is moderate. It's only around 7,236 USD. That means disposable income is significantly limited compared to, say, Western European markets.
Right, less money to spend on leisure activities like gambling.
Pres-
So, okay, we've got a small aging market with limited discretionary spending. That sounds like a challenging proposition on its own. But you mentioned the report highlights a major paradox here. Their technological foundation actually rivals Western Europe.
This is where it gets really interesting, yeah. Their digital excellence is, frankly, undeniable. Internet penetration is super high, 91.5%. Mobile connections are actually over 100%, 127%, meaning lots of people have multiple connections.
Impressive numbers.
And most notably, their fiber optic coverage, the backbone for fast internet, is the second highest in all of Europe. Only Iceland beats them.
Wow, second highest. Ahead of places like Germany or the UK.
Ahead of most places, yeah. Combine that with a near-universal 99% literacy rate, and what you have is a potential player base that is highly digitally literate and very well connected.
Okay, so the infrastructure is there, even if the spending power isn't massive. What does that mean for player behavior?
Well, that tech foundation means that while the market is small, the players they do manage to acquire are likely sophisticated digital consumers. They know their way around online platforms.
Right, and preferences.
Culturally, it's also pretty clear. Russian is the dominant language, and platform support in Russian isn't just recommended, it's mandatory.
Okay, essential.
Activity-wise, sports betting enjoys a really strong cultural affinity. Think ice hockey, football, basketball. Those are big.
Makes sense. But we come back to the money.
We always come back to the money. Because of those income constraints, the average revenue per user, or ARPU, is estimated to be moderate at best. These consumers are inherently price conscious. They're highly sensitive to deals, meaning you'll see intense competition for that limited pool of players, and that competition will center aggressively on promotions, bonuses, free bets, which of course further erodes operator margins.
Right, a race to the bottom on bonuses potentially. And when these players do decide to bet, how are they handling payments? We're dealing with a local banking system, obviously, but can operators integrate global payment solutions? Or is it all local?
It's a necessary mix, really. They rely heavily on their national card system, Belcart.
Okay.
But you also see Visa and MasterCard used, though, and this is a big caveat. The functionality of international cards is continually subject to disruption because of international sanctions. You can't fully rely on them.
Unpredictable then.
Very. And crucially, operators absolutely must integrate with local e-wallets, things like WebPay, iPay, and the mandatory state payment gateway system called ERI.
ERI.
Yeah, it's a unified payment system. So integrating all of that adds another layer of required localization, complexity, and cost.
And more dependence on local systems.
Exactly, and we absolutely have to point out the significant oddity in their payment regulations, despite Belarus having, in other areas, quite progressive laws around cryptocurrency trading.
Right, they were known for that for a bit.
Yeah. But the use of cryptocurrency for any gambling activities is strictly and explicitly prohibited, banned.
Huh, that's strange. Why?
The report doesn't speculate too much on the why, but the effect is clear. It eliminates a potentially technologically savvy segment of players who might prefer crypto, and it creates extra compliance headaches for operators who might use crypto elsewhere.
Okay, so no crypto gambling. Got it. Now, all these operational hurdles, the financial barriers, it sounds like it leads us inevitably to the final and maybe the most critical section of the report, the extreme risk assessment.
Yeah, this is where it gets really serious. For any international entity looking at this, the authoritarian political regime under President Lukashenko creates a risk environment that, frankly, fundamentally deters major investment for
But
most.
you're talking about regulatory unpredictability, right? The fear that rules can just change arbitrarily overnight with no warning.
That's a huge part of it. Can I give an example the report highlights?
Please do.
Okay, look at the recent 2025 decree, or rather, the decree about 2025, authorizing Belarusian banks to start blocking cross-border gambling payments going to unlicensed operators.
Okay, so cracking down on the gray market, that sounds like it could benefit licensed operators, no?
On the surface, yes. It theoretically helps licensed local operators by trying to eliminate that offshore competition. But the way it was done, the fact that such a major rule, one that directly controls capital flow and enforcement, can just be enacted suddenly by decree, it demonstrates the utter instability of the regulatory environment. What's stopping them from changing rules that affect licensed operators just as quickly?
Good point. That kind of unpredictability is poison for investment planning.
Exactly. And furthermore, you have to listen to the political rhetoric. It's like a flashing red light. President Lukashenko's comments around the same time suggesting that gambling was, and I quote, thriving a little too well. Very. That signals that future restrictions, maybe sudden tax hikes, could be imposed at basically any moment, eroding profitability without any input or consultation from the industry itself.
And we haven't even fully dug into the impact of Western sanctions yet. For an international business, surely this hits the bottom line hard, especially when it comes to actually getting profits out of the country.
Oh, absolutely. That's a massive operational headache. Western sanctions severely restrict traditional international payment processing and normal banking relationships,
I-
meaning profit repatriation. The simple act of getting the cash you earned in Belarus back to your corporate headquarters in, say, London or Malta becomes incredibly difficult, if not impossible, through normal channels.
How do companies deal with that?
Well, most major Western correspondent banks have basically de-risked. They just refuse to touch transactions linked to Belarus these days. So you might be forced to find these complex, high-friction, often non-Western banking solutions, maybe through intermediary countries or specialized providers, all of which severely erodes the actual value of the capital you manage to make inside the country. Fees, delays, currency risks. It adds up.
Okay, let's try and bring all these high barriers, the operational costs, the risks, together for a final financial assessment.
Yeah.
Given the market constraints, we talked about small population, limited income, what do the unit economics look like for acquiring a player?
They look pretty grim, honestly. The addressable market, as we said, is tiny. The report estimates maybe at the absolute maximum 300,000 to 500,000 active players in the whole country.
That's a very small pool.
Extremely small.
Yeah.
And because you're fighting tooth and nail with competitors for such a small, fixed pool of customers, the customer acquisition cost, or CPA, is estimated to be incredibly high. The report puts it likely in the range of $200 to $400 per player.
$200 to $400 per player in a market with moderate ARPU.
Exactly. Those are terrible unit economics, especially when you pair them with the huge initial investment required, particularly that locked up capital.
So profitability must be a long way off.
Glacial is the word the report almost uses. Considering the massive locked capital, the high operational costs, the high C, the profitability timeline is projected to be very long. Break-even, the report suggests, will require a minimum of 3 to 5 years.
3 to 5 years minimum.
And crucially, that's assuming perfect regulatory stability during that time, which, as we've just discussed at length, is, well, it's a very heroic assumption in this particular market.
Right. How unlikely. So pulling it all together, what's the final verdict from the Gambling Databases research team? What's their conclusion on the actual viability of this market for international operators?
Their conclusion is pretty unequivocal, really. This market is suitable only for extremely well-capitalized operators. We're talking companies needing $3 million or more in total capital just for the launch and initial operations.
Okay, so big players only.
Big players with patience. They need a 5-year plus investment horizon, and maybe most importantly, they need an exceptionally high tolerance for political risk. The report flat out states that the required 985,500 locked reserve, just that one item alone, acts as that deliberate barrier we discussed and probably eliminates 90% of potential foreign entrants right off the bat.
Wow, 90%. So the core lesson here seems pretty stark. Belarus is a true niche market where that low 4% GGR tax is, as you called it earlier, pure bait.
Absolutely.
It doesn't remotely outweigh the required locked capital, the need to build local infrastructure, those prohibitively high labor costs thanks to the 34% social contribution, and overarching everything, the inherent political volatility.
And summarize it better.
And the report suggests that if, despite all this, an operator does decide to proceed, the absolute critical factors for any chance of success are total compliance excellence, dotting every I, crossing every time locally, and deep, native Russian language operational expertise. You can't fake that.
No, you really can't. And maybe a final provocative thought to leave people with, something the report touches on implicitly. When you consider that mandatory local server rule, the requirement to host all your proprietary data, your player data, everything within the country, when you combine that with the history of arbitrary regulatory changes we've seen, it really raises an important, maybe uncomfortable question. How much control, particularly over their most valuable data assets, do foreign operators truly surrender when they commit millions to operate inside an authoritarian regime like this?
That's a heavy question. That surrender of control, of data sovereignty almost, has to be weighed incredibly heavily before anyone takes the plunge.
It absolutely must.
So that is definitely something to reflect upon. This deep dive, as we mentioned, was based on extensive research and analysis conducted by the Gambling Databases research team. They really do the work.
They do.
And for the full text of this report on Belarus, and there are other detailed country reports covering markets all over the globe, which explore all these key aspects in even greater detail, you can visit their website. It's gamblingdatabases.com.